All right, good afternoon, everyone. For those of you who have just joined, my name is Bruce Lynn. I'm one of the managing partners of the Financial Executives Consulting Group. Today, we're going to be talking about thinking about selling your business, ride the tidal wave of deals. We will be talking about this for the next 45 minutes or so. You are in mute-only mode, so if you have questions about today's presentation, please type them into the question box. If we don't get to your questions online, we'll take them offline. And for those of you who do not want me to read the questions out loud, just send me an email, and of course, we'll take those offline. This session is being recorded, and you will get a link to the recording a little bit later, probably tomorrow or Monday. So without further ado, let me introduce you to Ramsey Goodrich, who will talk about today's topic. Ramsey, go ahead.
Great. Hey, Bruce, thank you so much for having me again. I love our partnership that we have with FENG and all the resources you guys can provide to all of our targets in our prospects. So thank you so much for having me back again. This is always fun to do this, and so we really do appreciate it. So let me start off. Good afternoon, everybody. Thank you for joining us. I can't believe that people actually want to listen to me speak. So I'm honored to be here, and hopefully we can have a little fun. As Bruce said, we're going to go through really, really fast today. So if anybody has follow-up questions, comments, concerns, arguments, disagreements, please shoot them over to Bruce, and he'll stop me along the way, or we can do some Q&A at the end of the session. So, but appreciate your time today. So as Bruce said, I'm Ramsey Goodrich. I'm a managing partner here at Carter Morse Goodrich. Carter Morse Goodrich is a boutique investment bank in Southport, Connecticut. We're in probably the coolest building of all time, that is our office right there on the island in the middle of the Mill River, overlooking Long Island Sound. So we are 14 people, where we specialize in doing once-in-a-lifetime transactions for families and founders that value really great advice. They're doing this the first time and only time in their lifetime. If you can do it right, if you do it once, you should do it right. And that's really our philosophy from start to finish. Give you 30 seconds of background on us and who we are. You know, as we said, mainly family and founder led, somewhere in the 50 to 150 million range. We love doing larger ones as well. Because we're multi-generational focused, we tend to do more industrial business services, manufacturing type of businesses, primarily sell side. We are agnostic as to the process and agnostic as the outcome of the transaction. It really depends on the needs and desires of our owner operators. What's interesting is when you come to buyers, in over 400 transactions over 37 years, we've never sold two companies to the same buyer. So that's how specific we get to make sure we hit our objectives. As we say, our niche is trusted M&A advisor for families and founders, really 50, 150, where we think of these three circles as families and founders with unbiased advice with great execution. When you can bring all three together, it really makes a big difference. So thrilled to be talking to you today. We do lots of transactions. Anybody wants a copy of this presentation when we're done, we're happy to forward it along and potentially talk with you about what you're doing in your neck of the woods. So what's happening in the state of the market? It's impossible to get to what recommendation we can make without giving some background on where we are with the state of the markets right now. And so let's rip through a couple of quick slides here. The overall market, 2021 was a remarkable year by every single definition of the term, from a volume perspective, from a multiple perspective, from a lending perspective, from a private equity perspective, from a strategic perspective. 2021 was remarkable. It was truly a once in a lifetime. The first half of 22 was on that same pace, and then everybody came back from summer vacation, and the Fed started increasing interest rates, and the world came to a screaming halt from a volume perspective. These dollars that you see up here on a global basis and on a North American market are really indicative. But what's happening is that general trend of a slowdown in both volume and dollar amount here. It's a little bit misleading, but we'll get to that in a second. But you can see there's been a real slowdown since 2021. We are expecting a huge rebound. coming up fairly quickly, and we'll get into some of those dynamics as well. Similarly, valuations are still historically high, but reverting back to normal levels, I would say. Whether that be private equity or global or North American. The multiples, though, don't be fooled. Because volume's so far down, the only companies that are really trading right now are A-level companies, the best of the best of the best companies, because those are the ones that are commanding great premiums. Private equity folks especially are chasing those deals and keeping multiples very high. What you don't see in here is all the companies that didn't sell or aren't coming to market, those B and C level companies, so the data here, while indicative, is somewhat flawed. And so don't take too much stock in this. What's driving that? What's driving M&A right now is really the debt capital markets and whether or not you can borrow sufficient capital to make a return. You can see in 2020, second half of 21, 22 into 23, there was nothing happening. There was no debt available whatsoever other than deals that were already in process. But you can see on the right-hand side that all of those things are starting to spike again. The institutional loan market is starting. That will feed into the mezzanine lenders, which will then end up with the senior banks. And so we're waiting for them to catch up, but we're almost there. So let's talk about the importance of debt. And this is something that most folks don't understand, but is critical to the success of private equity, which is my return on my investment is directly tied to how much leverage I can put on it. I would always recommend that you use a prudent level of debt. We like 3 to 4 times as sort of a max. In 2007, we were talking about deals doing 5, 6, 7 times EBITDA to debt on a lend and pretend and extend without really any ramifications. That actually led us to the great financial crisis. So doing that again doesn't make a lot of sense. But so 3 to 4 times makes sense. Right now, even that's not available. So what we're seeing now is 1 to 2 times debt to EBITDA for new deals. I would just say we saw that back in the end of last year, the beginning part of this year. We're starting to see some cracks in it. But this chart down below is somewhat indicative. If you have a $50 million business doing 10% of EBITDA, about $5 million times 6, call it $30 million enterprise value. Basic, simple math, right? General rule of thumb is 50% equity, 50% debt. And a 6 multiple, that means you can buy it, roughly speaking, at 30 million, 15 of debt, 15 of equity. If you look at the bottom chart, that scenario open at 15 and 15, and you assume some growth rates and some really no real change in multiple, no change in EBITDA, and a standard 10% growth rate, that investor should be able to expect about a 26% return in their investment at about 3 times their money. That is about a standard middle market, center of the plate, really boring transaction that you can get to. So in 2021, we were over here. We could borrow 4 times leverage. And therefore, just by putting that much less equity, but the same exit, now all of a sudden I make 4.5 times my money, 37% IRR. For an equity investor, that's spectacular. So debt is really important to investors to maximize the return on their equity. In 22, 23, we swung the pendulum the other way. So now if I can't borrow that same 3 times, and let's say I can only borrow 2 times on that debt, now all of a sudden I'm only making 2 times my money, which most guys would say, that's pretty good. I would take that. I would definitely take that bet. But for most private equity investors, that's really not all that exciting. And so, but that's where we were, which means a lot of people didn't sell because they didn't think the equity folks could make a return because of the lack of leverage. That pendulum has swung from sort of 4.5 times to 2 to 2.5 times. We're at about 3 times right now. And I think we're going to see an improvement here going forward. But the key driver to the middle market M&A is debt availability. It is not the cost of capital. It has almost nothing to do with the expense of that debt. And by the way, where we are right now is where we probably should be. It's not egregiously high. We were lulled into complacency because of a 0% interest rate for the last several years. But if you look at a longer term history, we're back to about normal, given the facts and circumstances we're dealing with. We were artificially low for too long, so it feels bad, but the reality is it's not bad. It's about where we should be. Okay. So what does that do? That lack of availability has really, you can see here from a private equity perspective in particular, has really plummeted both the activity as well as the bigger deals are still happening, but smaller deals have really dropped off the face of the earth. That bottom chart, though, I think is really what's most important. That is equity capital that is available to be deployed in private equity funds right now. $955.7 billion needs to be put to work. Insurance companies, pension plans, institutional investors have plowed a lot of money into this asset class, expecting a better return than they can find in the public markets, and therefore they're sitting on a lot of capital. What we're seeing right now is that these limited partners, these investors behind the private equity funds, are doing two things. It's really interesting. On one end of the spectrum, they're saying, I've given you a lot of money, go deploy it, go put it to work, go buy stuff, right? On the same time, these private equity folks haven't sold anything, so that same investor is saying, go put it to work, but I want my money back. You got to sell what you've been in for too long now, sell, sell, sell. Well, if you're getting the signal of buy, 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 and sell, 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 at some point you have to follow the instructions and get a transaction done. And so we're going to see this wave of investment capital be deployed and realized going into second half of 24, more importantly into 2025. So what we're seeing right now in the overall is a bifurcated market. You have A-level companies. Those are the ones that are still going. Those have great management teams. They're non-cyclical, highly recurring revenue, data-driven analytics, great audits, 3 years of audits. They are commanding super high premiums right now. And we've been seeing multiples in that 10, 12, 15 times, really because of the supply and demand imbalance. There's not enough companies for sale right now. So those that are really good, everybody's chasing. I was talking to a good friend of mine that I grew up with that happens to run a private equity fund out of Boston. And he said, I've been chasing everything. My last 9 offers have been summarily rejected because somebody outbid me. And so those A-level companies are going for huge premiums right now. The B-level companies, the companies we tend to deal with, family-run, solid, consistent, maybe needs some investment, maybe needs an upgrade here and there, probably could use some capital infusion, but really good, solid companies. Those folks haven't really come to market recently. And we'll get into that a little bit more in a minute. Multiples have retreated back from 2021, but have remained fairly stable for those that have come to market. You're really looking at a basic manufacturing company that's 7, 8, 9 times, where we used to be your 5 or 6 or 7. So there's it's still a rounding up effect, but not quite what we saw back in 2021. And that's really driven by the debt and the lack of availability in debt to facilitate that volume. Unfortunately, we do see some C-level companies, some ones that need some help, some operationally challenged, those that were working on razor-thin margins and got hit with supply chain issues, or that were highly leveraged that now the interest rate the interest expense is killing them. They may not have the strongest management teams. Those folks, I will tell you, there's almost no appetite for that right now in the markets. We're even talking to distressed investors. They're not even going after things because they just don't know where the economy is going right now. So a lot of this has been driven by, in 2021, money was free and easy and plenty of availability. 2022 was a tale of 2 cities. First half was fantastic. Second half was on lockdown. 2023 was really challenging only because of an interest rate kept going up and up and up, and nobody knew how high up was. Now, here we are in 24, and we found stability. We don't think it's going to go up anymore. We don't know when it's going to come down. We've at least found stability. Everybody's exhaling. It's going, okay, I can deal with this now. I'm back to stable. You exacerbate that same timeline with you were dealing with COVID in 2020 and 2021. You had supply chain issues in 22 and going into 23. You had interest rate spikes in 23 into 24. Now, though, again, we're back into solid stability. We're okay. We're good. What we haven't seen yet, and this is going to be the key and fundamental to unlocking M&A, is we haven't found confidence yet. We could be going up, we could be going down. Inflation is up one day because jobs came in way over expectations, but then PPI came in today much lower than expectations. So we still don't have confidence of what direction we're going to. Remember, the buyers and investors buy for the future. So if I don't know where I'm going, I can't buy yet. I can't deploy that capital. And so we haven't seen that. So as soon as we find some confidence in the marketplace, you're going to see the markets open up. You're going to see a ton of value coming forward into the marketplace. Then you exacerbate that by some stock market valuations. Stock market, generally speaking, goes in 6 or 7 year cycles. You can go all the way back to the 80s and the inflation that we had, back to the crash of 87. Then there was the real estate bubble and bust in 93, then which happened to be 6, 7 years later, right? From 93, we had the dot-com bubble, which took us to 2000, 2001, right? We all remember that one. You can see it on the chart. It sort of hurt us all, unless you were in a couple of key stocks. Then 6 years later, magically, another 6 year cycle, we hit our 2007 credit crisis, 2007, 2008. Took us a year or two to get out of that one, so because that one hurt. But does anybody remember what happened in 2016? I'll give you a minute to think about it. What major economic issue happened in 2016? Nothing. That's right. Absolutely nothing happened in 2016. If you look at the stock market chart, it paused for several months and then took off at its torrid pace of growth again. And so we missed an economic cycle that normally flushes out some sellers and normally gets some M&A markets to reset itself. So now, all of a sudden, 2016 plus 7 years, you're back to 2023. We're right on schedule to have another economic cycle. You can go back all the way in history, and this is generally true throughout. So 2023, despite the temporary effects of COVID was a flash in the pan, and we went down by a ton, and we came roaring back even harder. So now we've had that little blip, but the question that we have right now, as we're coming out of this, is where do we go from here? And so sellers look at this cycle and say, well, trying to time the market probably doesn't make sense, but once we find some confidence, you're going to see a lot of deals come to market. So what we're hearing from our clients, our multi-generational family businesses, there's things like, I don't want to work anymore. And these are actual quotes from our clients. Ready? Works really hard. It used to be fun, but now it's hard. Regulation, labor, supply chain, COVID, interest rate. It's really hard these days. I don't really have to work. I have more money than I can spend. Most of our clients have been very successful for generations, and therefore it's not about necessarily a monetization event as much as it is a lifestyle change. I want to focus on somewhere else. This is an actual quote from a client of ours in California, and he said, Ram, you won't believe this, but I actually like my wife, and I want to spend more time with her. So can you help me sell the business? And I want to do it now when I'm young and go have some more fun with her and do some travel. And so always an interesting way to position it. I think it really clarifies the issue. And here's the other one that we're seeing a lot. I'm sure you are too. I don't have somebody to take it over. I don't trust my management team. My kids don't want it. My wife, we're really getting pressed to do something. if my kids were in it, it would be great, but they're not. They're all doctors and lawyers and Indian chiefs, not working on a greasy machine shop down on the factory floor. So that's what's really driving middle market private company M&A. What's interesting, and you would think you'd hear more of this, but we don't. We don't really talk about inflation or stock market concerns or global risks or conflicts or health concerns. This year in particular, we are months away from a every 4-year election here in the United States, and yet nobody's talking about it. Nobody's preparing for it. Nobody's doing anything about it. It just is. I don't know if that's good or bad, other than I think everybody's expecting more gridlock in Washington, but I don't want to get political in this presentation. So what we're seeing is a bunch of converging forces creating this massive tidal wave that will be coming to market. You've got pent-up demand. We just talked about $950 billion in private equity that's waiting for something to be put to work. Strategic buyers are sitting on $1.6 trillion in cash in the S&P 500 right now. And they have to start putting money to capital to work to create some incremental growth. Everybody's sort of growing at an anemic rate, and they need to put capital to work to go spur growth, innovation, access to new markets. So we have plenty of demand. For the record, we always have more demand than supply. I've given this presentation for almost 2 decades now, and I would tell you we always have more capital than we have deal flow. So that's not really anything new. It just has always been there. But it's still true. The dollar amounts are much larger now than they ever have been. On the supply side, private equity sellers have been sitting on their portfolio companies a little too long. We're talking about continuation vehicles. We're talking about recaps. We're talking about other ways to sell secondary markets, sell pieces of equity to create liquidity for my limited partners without actually doing anything. They're not selling it. So we've got this supply of years worth of private equity folks that have not yet sold. Similarly, private sellers, we talked about COVID, we talked about supply chain, we talked about interest rates, found stability. We missed the last economic cycle. Then we hit a 3-year waiting list. We've got 4, 5, 6 years worth of supply just getting ready to come to market. What we didn't put in here is the demographics that are actually exacerbating that. We have an older population that wants to sell. There was a great book that was written probably 6, 7 years ago called this $10 trillion opportunity that listed 10,000 businesses in America that were needed to change hands in the next 10 years. Well, if that was 4 or 5 years ago, and we haven't done much with it, they now estimate that it's a $14 trillion opportunity for almost the same 10,000 businesses that need to transfer and change hands. Exacerbate that with an upcoming estate plan change at the end of next year that I think is going to really drive a lot of activity as well. To take advantage of lifetime exemption and gifting and trust. Call your financial expert. If you need a referral, let me know. We work with some great folks, but there's some good planning that can be done there as well. So we have pent-up demand. We've got pent-up supply. We've got valuations that are really high in the stock market right now. You've got a rebounding debt market and this election year that nobody's talking about. So we have every single force is coming to play here. We're just waiting for something to happen. So the question is, what's it going to take? What's it going to take to get this whole market of supply and demand and everything else to get rolling? We were just out in Las Vegas at a trade show called DealMax, which is hosted by the Association of Corporate Growth. We have 3,200 private equity investment bankers and the professional staff around it all converge in Las Vegas for 4 days. The consistent theme from everyone that we talked to was we just need to see a Fed rate decrease. Again, we talked about that it's not about the cost of capital. So it's not about a 25 or 50 basis point decrease. It has almost no difference of how big the cut is, only that there is a cut, that there is a reduction in that rate, because that will move us from that stability thing and now give us some confidence that we're moving in the right direction. And when that confidence comes, floodgates open, lenders start lending, Private equity starts selling, which will be followed by private sellers. So I think we think that in 2025, you're going to see a lot of folks close out the year, print their 24 numbers, and come to market in the first half of 25. So as soon as we see it come. So what does that all mean for you today? If you are an A company, one that is really good, that has great management, data-driven decisions, and 3 years of audits, take advantage of this market while you have it. There's a huge supply and demand imbalance that the premiums that are being paid for A companies are great. When this tidal wave crashes to shore, you're just going to be another company. You'll probably still get a premium valuation, but not like you're going to see today. With the volume of deals coming to market, you're going to see a supply and demand shift. You're going to have much more supply, much more options. And so as an investor, what am I thinking? I want the best return on my investment. So if I can buy something else a little bit cheaper and improve it, I can make more money doing that rather than buying a great company and riding it out. So if you're an A company, one piece of advice is to take advantage of today's value and start to think about coming to market sooner rather than later. You still have time to get it into the market this year. Probably close, if you started today, you're probably closing in the first quarter of next year before the wave hits. If you're a B-level company, our recommendation is to prepare. Get ready, because here it comes. Once the floodgates open, you're going to get a lot more inbound calls, you get a lot more pressure to sell, and you're going to see valuations adjust accordingly. What does prepare mean? Well, there's lots of things to prepare we'll get to in a minute, but there's some low-hanging fruit that you can still take advantage of today that make a huge difference at the outset. So you should start to plan for when an exit and the personal objectives of the owners align. It's less about timing the market. It's more about when the personal objectives of the owners match the market itself. And with a company that's ready, you need all three pieces: company, market, and owners to all be aligned. When those stars align, that's a good time to come out. If you're a C company, frankly, our recommendation is get to a B company. Do what you need to do to get you up to a B company. Make that right investment, make those adjustments. If you have to cut a little bit, do that, trim the expenses, and then plan for an exit when the business community is ready for it. You may not have the luxury of matching it with a personal objective, but rather when the business and that market is ready. That was a lot to cover. So now we've got a few minutes left. So let me rip through here are some options. And most private sellers think about selling a business in two ways. I have 100%, I own 100%, I'm going to be in it 100%, I make all the decisions, it's mine, or I'm out. There's every flavor in between that you could possibly imagine. So really, we spend an exorbitant amount of time, I'd invite you to do the same thing, of really understanding the objectives. What's the definition of success? Not on a dollar sign. The market will tell you what the value of the business is, but what is the personal objective? What is the outcome that you're trying to achieve here? Is it some liquidity but still have a say? Is it a major liquidity event but back off from the day-to-day operations, or is it to walk away completely? There's no shortage of options once we understand the objectives, and they're plentiful. Valuation is driven both by quantitative analysis that we're all skilled in. This is where we can have fun with numbers. I'll get to the punchline, which is it's fun with numbers. We can make any company worth anything at any time for any reason. But there are some standard approaches to the mathematics behind valuation. But that really takes a secondary consideration. That puts in the ballpark. Now, how do you look at qualitative considerations? The softer stuff, brand, management, systems, controls, those are harder to quantify. There's no one-to-one relationship. There's no mathematical formula you can put it in. Those are much more subjective. And that's where beauty is in the eye of the beholder, but you have to factor all those things in. If you look at valuation, it's a very simple formula, right? Earnings times a multiple plus or minus adjustments. The challenge is, what is earnings? We always go by EBITDA. but we also always adjust EBITDA. We normalize EBITDA. That's a mathematical exercise as well. It is going to be what it is. And so now how do you affect the multiple, which is the more important thing to drive? If I can get a multiple of earnings, I would rather get a multiple of it than an incremental dollar of earnings, because I'd rather have the multiple of it. Those are the softer stuff. How do you talk about management and growth and perspective and vision? And if I can just turn one turn of EBITDA higher, then all of a sudden that it's almost exponential effect on valuation. On the slide here, we have plus or minus adjustments. I will tell you it's only minus. We try to be polite and say plus, but once you say yes, there only can go down at that point. So this is where preparation comes in, and make sure that you don't have a retrade, that you're prepared to go into a lengthy due diligence process and get ready to go. So here's the pop quiz. You ready? Assume you have two businesses, both 50 million, both 10% margins, both 5 million of EBITDA, both in the same industry. Are they worth the same? Probably not. Because what happens if one's highly recurring revenue, one's only opportunistic? One's a lot of small transactions, one's one or two really big ones. One has a full pipeline of new prospects, and one's resting on their laurels. You can see how now mathematics is only a piece of the equation. You've got to get into the subjective or the qualitative side as well. And while it's hard to value these things, you can model it out and have some better guidance of managing expectations. No two companies are worth the same. I don't care what your friend at the country club sold his business for. Don't use that as a proxy for your business. We are obsessed with looking at two things more than anything else. First, on the left, 9 key components of what really drives value. Is it profitable? Can I improve profitability? Is it defendable? Is somebody going to come eat my lunch or not? Is it repeatable? Is it highly recurring? Does it just happen automatically? Is it scalable? If I double or triple the business, can it keep up with me? Is it transferable? Meaning, if the owner leaves, what happens? Does he have all the relationships, or is it easy to do? And therefore, is it manageable? Do I have a good management team in place that can run the business going forward? Is it leverageable? Meaning, can I borrow and enhance my equity return? And is it dependable? Not defendable, but dependable. It just happens no matter what. Am I in the right industry space? And believe it or not, one of the key considerations is it saleable? Who buys this next? And is there a good, robust market for that? That's a long-winded way to get to a very simple concept: is value is the inverse of risk. If I lower my risk, I increase my value. So what we are obsessed with when we're working with our clients is really trying to articulate a story of minimizing risk and therefore increasing value. The more you can decrease risk, however defined, that company will be more valuable going forward. But remember that we're only talking about a purchase price. And if you look at the iceberg of value, it's a horrible term, but it's effective visual. The only thing we can see is the purchase price. It's the only quantifiable, measurable number on a page thing that we have to judge success, and that is purchase price. But there's so many other definitions of value. What if it's a stock deal versus an asset deal? What if it's all cash versus an earnout? What if you have an employment contract or you don't? What about net working capital? What are the liabilities you have to keep post-closing? What can you transfer to the buyer? How certain is it to closing? There's so many other things that have real value. It's an interesting stat that my partners hate it when I say this, but when we run auction processes and we get 10 or 15 offers, we talk to 4 or 5, and then we finally pick our right partner, rarely do they take the highest price. Think about that for a minute. There's some other definition of value that's meaningful enough to leave millions of dollars on the table by choosing a different buyer, because there's a different definition of value. A lot of times it might be legacy. It might be taking care of my employees. It might be taking care of my management team. But there's some other definition of value that's not just purchase price. So please don't focus on price or multiple when there's so many other definitions there. Bruce, I got 10 minutes to rip through this, so I promise I'll do it quick. Let's use a quick case study, right? This is your company. and you can substitute any number here, it's all math. Let's say you are a $50 million manufacturing business with 10% revenue growth, 10% margins, i.e. $5 million of EBITDA, and generally speaking, valued at 6 times. Therefore, theoretically, worth $30 million today. So now what do? Do you go to market today? Do you wait? Well, it sort of depends. If you waited and did nothing and just rode out 10% growth for 3 years without any improvement in EBITDA growth rates or anything else, still sell it 6 times, you'd get almost $40 million of value. Good reason to wait, but it really depends on the personal objectives of the owner, right? But if you don't prepare, here's what's happened. You ready? There's about a 15% decrease in that value because something popped up in due diligence, because it wasn't an effective process, because the risk wasn't mitigated before closing. So that while you could wait and get 40, you might get 33. Who knows what number that's going to be. But if it closes at all, without preparation, you're not going to do very well. However, what if you talked to your owner and said, what if I did this? What if I start looking, instead of at the numbers, but start looking at value differently? What happens if I just focus on little things that I can control, right? What if I told you you could get almost $60 million for the same business, doing the same thing with just a few tiny little tweaks? You ready? Increase your margin by 1% for each year for 3 years. Your 10% goes to 11% to 12%. I guarantee you the CFOs on this phone call can find 1% of operating savings somewhere in their business each year. So just by finding that 1%, that would be amazing. By finding that 1%, you also show momentum, and you show that you're getting better, and you get credit for that momentum. So you're going to increase the multiple from a 6 to a 7. Which, by the way, mathematically gets you to $56.3 million for a company that was worth $30 million today. This is the private equity playbook. This is how they make money. This is nothing new. And so if we kept that same 50 million and just grew to 10% a year, like we do every year, as we have for generations, but we take EBITDA from 5 or 10% to 11% to 12%, right? And we take that multiple from 6, here it's 6.4, but if you substitute that 7 here, that gets you to 56 million. But they generally speaking have a 5-year exit. So let's go there. Let's use a 5-year exit. And we say revenue grows at 10%, and I go from 10 to 11 to 12 to 13, 15. Now I'm at $12 million of EBITDA, and I go from 6 to 7. Right there, just on the face of it, is $84 million. You've just taken a good business and made it really great. We have a general rule of 25. If you add your growth rate to your EBITDA margin, in this case, at the opening 10% plus 10% is 20%, you're a good company. If you can get that to 25 or even 30%, you've now crossed the barrier into a great company, and people will pay up for that. And so we haven't talked the scenario whereby you increase revenue 1% a year as well. But if you did that, here are the numbers down below. If you did nothing and held the same company with no improvement for 5 years, you'd be at 48 million. If you only increased revenue, you'd be 56. If you only increase EBITDA, you'd be 64. But if you did everything, you increase revenue by 1% a year, you increase EBITDA by 1% a year, and you increase the multiple by 1 turn. Now all of a sudden you're firing at all 3 cylinders, and that same $30 million business is now worth 112. How do you eat an elephant? 1 bite at a time. Small incremental improvements really add up tremendously over time. And this is our message for today. Small incremental improvements add up very quickly. Okay? So now let's go through. So what should I do? That's great background, Rams. Thank you very much for wasting the last 40 minutes of my time. What should I do? Well, first and foremost, if you're thinking about doing a transaction, build your team. We call this our core 4. Any transaction has to have 4 really good advisors at the table getting you ready to go. I'm a little biased, but you start with the investment banker, because that person is going to have the expertise of the markets and understand positioning and storytelling and be the quarterback for the transaction. You need really good accounting team. And that's everyone from accounting to audit to tax to a Q of E, a quality of earnings report. Most of our clients don't have 3 years of audits. Even if they did, we would still do a quality of earnings where you can do things differently and reposition the financials to take out personal expenses and one-time charges and abnormal expenses and reposition things to put the company in the best light going forward for that new owner. So quality of earnings, tax, and accounting, right? On the other side, legal. Another bad analogy. Ready? Hold on for it. A dentist and a brain surgeon are both doctors. They both went to medical school. They both are experts of their field. They both use a drill. I would never use a dentist to do brain surgery. Please go hire the best lawyer you can that is an expert in M&A and capital transactions. Not your divorce attorney, not your contract attorney, not your real estate attorney, an M&A person. Dentists and brain surgeons are not the same thing. So go hire the best legal counsel you can. And they help bring in all the other area experts as well. Most important, especially for private sellers, owner-operators, multi-generational families, is having that wealth management plan. We need them at the table up front. Right now, until the end of 25, there is a fantastic, I won't call it a loophole because it's law, that enables you to gift shares of a company at a discount. So when you sell it, it comes out of your estate plan and therefore avoids almost a 50% estate tax. And so by bringing that wealth management team in place that can bring in the trust estates, the wealth management, there's a huge tax savings on the proceeds, number one. Number two, that wealth manager can also give great confidence that this is the right thing to do. I have enough money to hit all of my dreams and buy the boat and the second house on Nantucket and take a vacation and I can retire and I'm good. But without that confidence, it's really tough to get a deal. So you need your core four and use them to access everybody else as well. So build your trusted network quickly. If you're thinking about it now, 6 months prior, get the trust and estates going. You ready for this? Do your environmental phase one. Everyone says, yeah, we're good. We've been surprised more times than not of really silly things that could be taken care of. If you go back to minimize risk to increase value, if you can identify that there's no problems, there's no risk, and therefore valuation goes up. If you identify a problem and there is a problem, well, then you can mitigate it. You've decreased risk and increased value. So get the environmental down. Get the management incentive plan done. Every owner we work with is always excited about sharing the upside with his management team. And so get that planning now, even just a couple of months in advance. And then go read the article on our website about low-hanging fruit. Some really obvious, simple things you can do today to really increase value. And why would you give it to a buyer when you could take advantage of it yourself? If at the end of the year, if you're thinking about doing a deal next year, upgrade to an audit. If there's any CPAs in line, you're welcome. But it really does help to have that discipline of going through an audit and audit-like procedures. And it gives great confidence to the buyer that there's no real financial risk. Again, increasing value. Look at your working capital. There's real dollars there. If you're carrying excess AR or excess inventory, start to rationalize it now, because we use averages over the last 12 months to determine that. So if that average is coming down, we can argue for momentum and therefore leaving. You can take more capital out of the business sooner. Before the transaction, I say here 3 months. Start it now. Start building it. You have the amount of work that goes into any M&A transaction is finite. It's fixed. It's the same amount of work no matter how long you want to do it. Now, the question is up to you. Do you want to do it over 12 months and take your time? Do you want to do it over 12 weeks and be a little bit stressed out? Or do you want to do it over 12 days and rip your hair out? It's the same amount of work. It always has to get done. There's no shortcutting this thing. So you might as well take your time and manage it over a longer period of time. So still start to build your data room, get counsel involved, build your core 4 team, get started early. All right, Bruce, I promise not to do a shameless plug, but I lied. So when do you call your friendly investment banker? Early and often is the short answer. And really, we'll do this in a couple of different ways. First and foremost is educate. Learn what the market is doing. Explain the process. Think about an exit strategy. Explore all the different options. It's not binary, as we said. There's everything we can do. Number one. Number two, explore strategic options. Think about a majority versus a minority, a private equity versus growth capital versus a strategic sale. There's every flavor in between. So let's think about what the ramifications and the good, bad, and the ugly are, and what's within the realm of possibilities. And then a reality check. Every one of our owners thinks their business is worth more than it probably is. And so let's have a dose of reality. Let's look at market-based valuations, look at financing terms and what might be available, and really figure out what kind of structure there can be. And lastly, understand the key business value drivers. As we talked about, you can get credit for momentum, so start that momentum now. There are ways to mitigate risk, increasing value. There's ways to highlight the positives and address the potential weakness. Sorry, I almost said weaknesses. There's no such thing as a weakness, only an opportunity. So who's the right partner that can look at that weakness and look at it as an opportunity to bring an expertise to go solve it? And that's going to be your ultimate partner here. So call us early, call us often. We love educating. We love having these discussions, but do it in advance. It's not, for us, it's not about the transaction. Yes, that's ultimately the success, but it's more about that education, developing relationships, and taking your time and getting ready for that transaction. So Bruce, I think that's all I got today. I got actually a lot more. We could keep going, but I think that's enough of these nice folks' time for the moment. Hopefully we got peppered questions, so let's have at it.
Well, we do. Thank you, Ramsey. We do have a couple of questions here. So let's see if I can take them in sort of reversed order here. First in, first out. On page 13, talks about what is a multiple? Is it on revenue or EBITDA?
Yes. Let me go to, all right. Every industry is valued a little bit differently. This simplistic formula is earnings multiple. The challenge is there's certain industries that don't really have a lot of earnings, especially for earlier stage companies, for technology stage companies or technology driven companies, and hyper growth companies. When we're doing consumer products companies, I hate seeing earnings in smaller consumer products companies, because that means you're not reinvesting in your growth. So from that perspective, we'd like to use a revenue multiple. If you're dealing with SaaS or technology, something we don't do, but you generally use a monthly recurring revenue multiple. So each industry is a little bit different. Some folks do it on a multiple of customer revenue. Some are, so every industry has their nuances of the metric. We're going to publish an article, hopefully next week, on EBITDA, which is the sort of the industry standard earnings before interest, taxes, depreciation, amortization. We used to call it EBITDAC. Take that same definition, add COVID. Retail stores do it on EBITDAR, which is before rent. So everyone has a sort of a nuance of what multiple they use, but figure out what the metric is for your industry and figure out what the reasonable realm of multiples are. Things like a manufacturing company is generally worth 6 to 8 times. Why? Because of the capital that needs to go into it and the slower growth rate and things like that. Aerospace, well, higher margin, probably selling a little bit more to the government, a little bit higher growth rate. Now all of a sudden that can be a 7 to 9. A consumer products company should be 10 to 12. Believe it or not, insurance brokers are like 14 to 16 times EBITDA. So every industry is different, what multiple range is appropriate, and every industry segment has her own basis for that, whether that be revenue or EBITDA or some other metrics that make sense. So there's no rule, it's a guidance. Did I sufficiently avoid the question, Bruce?
Okay. Yes, I think so.
Okay, good.
Here's another question for you. By lack of availability to debt, are you simply
Mhm.
saying banks aren't lending, or their threshold for lending is much higher than in the past, where not many loans got done, or both?
Yes, both. Coming out of starting in September of 22, we all came back from our Nantucket vacations and go, oh my God, what are we doing? And the banks essentially, if you didn't have a deal in process at that time, the banks closed their door and said, we're done. We don't know. We can't do anything because they literally just shut the door and said, we've got to deal with our portfolio of existing clients and have to analyze what this new interest rate is doing. If I went from 0 or 2 or 3%, they were modeling, we had one client of ours, the bank was actually modeling a 15% interest rate on their debt, 7 times what they were paying at the moment, which, needless to say, didn't look very good. And so for the second half of 22 into 23, the banks were just closed. Now they're starting to warm up again, but it's much more conservative. I just talked to 4 lenders yesterday about a potential transaction. We're looking at 2.5 times EBITDA. Good news is they're open. The good news is they're starting to lend again, but now it's hyper conservative because they still have those residual problem loans in their portfolio of clients at the moment. So they're starting to open up again. Hopefully there's no lenders on the call, but here we go. Ready? They don't get paid a bonus unless put capital to work. So every lender is trying to put capital to work right now, but the credit committees are still locking down. So they're looking for more loans to put on the books, but the credit committees are still pretty conservative. They're open, they're just not quite where we need them to be to spark an M&A run here. With an interest rate decrease, now all of a sudden I can model a decrease in interest rates, which creates more availability, which will open the banks even further up. The private credit markets have taken over that void, but is super expensive. It's not impossible, but it certainly is expensive.
All right, here's another question. For family-owned companies, is price the driver for selling, or is it weighed with taking care of employees for the future?
Let me see if I can find that slide again. You need 3 things to be successful in a sale of a family business, right? The company has to be ready and have survived, and I think most companies are ready or getting ready right now. The market has to be ready, and we're seeing that the markets are coming back, and the owner has to be ready. So what we're seeing is this slide of stuff. Most family owners are not driven because they're trying to time the market. Most of them, while this is a significant piece of their financial net worth, they may need the money, but they're not facing financial crisis. They don't have to sell. So it comes down to their desire for something different. Work is hard. I don't want to do it anymore. I actually like my wife. I don't have my kids. Those are what's really driving this. And it's a demographic shift that we're seeing more than anything else. If you go back to 2016, we didn't have the usual cycle of sellers. So those folks that could have, would have, should have sold back in 2016 are now 7 years older. So if you were 70 back then, you're now 77. How much longer can you really go? How much more do you really want to go? And so I think it's a demographic shift, it's a multi-generational shift, and it's a personal decision, not necessarily an economic one. We're not seeing multi-generational family businesses do things because of timing the market. Everybody wants to maximize value. I'm not saying don't maximize value. I am saying the viewpoint from which multi-generational family businesses, they're not looking at 6-year cycles, they're looking at 60 or 600-year cycles.
All right, here's another question. Some industries are likely to be disrupted by artificial intelligence.
Amen.
Do you see this affecting the valuation?
Yes, the question is, to go up or down? It depends on those that can adapt and adopt faster than others. AI is real. It's coming along. I remember, so My career on Wall Street started off pre-internet and everything else, where we actually went to the file room to pull old Wall Street journals to look at a stock price to build our stock charts. We didn't have this ready access that our kids here do now today. I can only imagine where it's going to go tomorrow. And that's true for manufacturing. It's true for technology. It's true for insurance. It's true for just about any industry out there. So those that can adapt and adopt faster, I think valuations go up. Those that are slower to adapt and adopt, I think valuation will be more challenging in years from now. This is not an issue that most folks need to address in the next 12, 24, 36 months. It's moving too fast. It's too new. Nobody took advantage of the internet until it was around for quite a while. And so I think and this is my personal opinion, I look at AI as the same thing on steroids, but it's going to take some adoption to get there. The world can't change that quickly. And we don't know the rules of the game yet. We don't know how to govern it. We don't know how to regulate it. We don't know how to adopt it. So yes, get ready. And I think we're all sort of thinking about how to do it. It will affect valuation, but it's just a matter of when. And that I don't have a crystal ball for. I'm just not that smart.
Well, my crystal ball's in the cleaners, so I don't have the answer here. All right, we got about a couple of minutes left, so this is sort of last call for questions for those of you who are still out there. And again, if you're interested, you will get a recording, so you can get the recording of Ramsey's presentation and all the questions. And at the same time, we will be sending out a PDF version. Ramsey, correct me if I'm wrong. We can send out a PDF version of this presentation.
I'll finalize this and get it off to you in just a minute.
Okay, so expect that early next week. So let's see. Well, here's a question. Contact information. I think Ramsey, you had your contact information at the end. I believe you did.
Sure. Put up on screen if I can find it here. There you go.
There you go. There we go. So for all
much better pictures of us on the internet on our website too, and plenty of content there. I would invite you to go explore, and we'd be happy to have any conversation with folks here to explore how we might be able to help.
All right. Well, good. Well, Ramsey, thank you very much for this presentation. I know that people will now take this away and go up to the mountain and think about what they're going to do over the next 6 months or so. So I appreciate all the effort you put into it.
Actually, Bruce, and thank you very much for having me again. And looking forward to the next one. This is always great. We love our partnership with FENG, and y'all are part of a great organization here.
All right. Well, thank you very much. And to everyone, thank you. And we will talk next time. Bye-bye, everyone.